I don't know where I started, but nevertheless, thank you all for joining. It's a Sunday morning, just before Diwali, after Durga Pujas. So, uh, I thought I'll take this opportunity to, quickly have a chat with all of you. Uh, I I've got some slides that I made just to ensure that I cover some main points that I wanted to discuss, and then we can have some question and answers. Uh, if you have any questions while I am speaking, feel free to put it in the chat box, and I will try and address them after we finish or while we are speaking. But mostly after after I complete the presentation. So first of all, we've now at a time of the year which is festive. We've just finished Durga Pujas. We're just you know a few days away from Diwali. Pretty much a month away from month and a half away from getting into the Christmas New Year mode. And Calcutta, I think personally, is the most festive from Durga Puja to about New Year. That is the my favorite time in Calcutta, and pretty much all of India, I would suppose. So let me start by wishing you all and all of your families, uh, my greetings for uh, Durga Puja, Diwali, Christmas, New Year, the entire festive season. So I wanted to take this time out and discuss what we've seen in the last 6 months. So we'll try and do this at least, if not on a quarterly basis, but definitely on a half yearly basis. We'll try and do this on a quarterly basis going forward. Uh, so firstly, I think this is a standard disclaimer. Otherwise, Gaurav is going to be behind me. Uh, all the data that we discuss today, any stocks that we discuss, all of it is basically for information purposes, and not an offer for sale, invitation, to buy or sell any of the things that we are talking about. I'll pause here for a few seconds so that you can quickly go through the standard disclaimer. Okay. Let me make this full screen. I think that might be better. Okay. So first things first, I think we've come to the end of the first half of this year. And although I am not a very big proponent of looking at performance on a very short time frame, because I think investing is like a test match or like a test series. Like you have to take it uh, over a period of time, and to see that consistency, in my opinion, is more important than just scoring runs in 5, 10 overs, and it's not a T20 game. Investing is more like a very long-term test career. Nevertheless, first half of this year, both Sri Lakshmi and Sri Vriddhi uh, have done fairly well. First half of I think Lakshmi was up roughly 20.5%. Vriddhi was up 24.5%. Last year, obviously, for people who've been invested in both the funds, were very good. And what is more important is the point, or the graph at the right, which is the performance since inception. Again, which has been fairly good, roughly 29-30% for Sri Lakshmi, and 34% for Sri Vriddhi over a 2.5
Bala, I don't
year
think we can see
period.
the screen.
You can't?
We can only see the cover slide.
I have moved to 1 second. Let me.
We can see the first things first slide.
Yeah, that's where I am.
No, the
Okay.
investor meet wala. Like we can't see the performance and everything
No,
on
so
website.
Mohit, you must be seeing a lag because there are other people who are able to see it.
No, first thing first is there.
Yeah, yeah. Okay. So let's go on. So I think what is more important is the inception to date. I think roughly whenever you're looking at performance, don't look at 1 year. I mean 1 month, 2 months, 3 months, 6 months, not even a year. And I'll talk about that a little bit later. But what is important as an investor is to, because we are investing with a long time horizon, right? When I'm saying a long time horizon, it could be 5 years, 8 years, 10 years, 20 years, 30 years. Uh, Sometimes people are investing not for themselves, but pretty much for the next generation. So what we really need is to take a long-term view. And this another important part is, especially in times like this, right? When there is too much of noise, there's too much of uncertainty, when every day you're getting bombarded with mostly negative news, right? It is important to take a bird's eye view of the world around us, pause, slow down, and see what are the actual important factors, that is going to impact us over the next 2, 3, 5, 10 years, right? Most of the time you will not even remember the news headlines a month later, right? People who there are things which keep happening, and the job of the news media, whether it is traditional news media, newspapers, uh, social media today, their job is to sensationalize uh, news flow, because that is what grabs eyeballs. And whether we like it or not, we get sucked into that, and that is the problem today we face, right? So what I'll quickly try and cover today is what is the situation that we see around us, uh, both in terms of the wars, economy, both global, Indian, uh, and where we see, what is happening in the markets, what is it, valuations, etc., that everyone's talking about, and what is our approach to navigating through this period. So first of all, I think what everybody is very, you know, everybody is seeing, right, is that, 1 second, let me mute everybody. There's some echo. Okay. So what we are seeing is that the world is suddenly, uh, there are too many conflicts going on around us. Russia-Ukraine war, very close to getting into its third year. Continuous news flow. Probably some of it has died down now because now people are taking it as business as usual. Uh, but there is conflict. Israel, Iran, Hezbollah, Hamas, Syria, Lebanon, all of that. The Middle East is up in flames. Every day there is some news flow of some bombing, some missile attack uh, happening in that area. And obviously, why these are important is these impact the global supply chain, whether it is through crude oil, whether it is through metals, chemicals, etc. Right. So if you take a overall picture, the world is now certainly uh, a very, very disturbed place, right? And so what is happening, because it is a disturbed place, we are seeing a recency bias coming in, not only in terms of the people who are in uh, defense companies, defense investors, as well as defense ministers, ministries, think tanks, armies across the world. So what we are seeing is defense spending growing, the nature of defense spending changing, right? So people are now spending a lot on electronic defense systems. They're spending a lot on drones, on cyber security. So the nature of warfare is changing, right? Uh, just a few weeks back, we saw what happened when pagers blew up, right? And this was something that none of us actually conceived in our mind that this is something that can happen, right? So uh, potentially anything which carries a electronic circuit and a battery could become an explosive. The mobile phone that all of us are glued to can suddenly become a agent of war. So this is what is happening, and this has a long-term implication in how we live, how we uh, get treated by security agencies. I will not be surprised if we see more and more stringency at airports, in railway stations when we are carrying electronic gadgets. Remember, for those of you who remember flying before 9/11, the checks were not half as stringent as they are today. So these kinds of events have a long-term impact on how we live and how investments are made in certain sectors. Globally, we are seeing growth is slowing down across the world, right? US growth is slowed down. Europe, pretty much everywhere growth is slowing down. Japan, China, everywhere growth is slowing down. Not all of it may not be on a year-on-year basis, but definitely over a 5-year period, growth is slowing down remarkably. India and a few other such countries, but India predominantly being a larger one, is one of those few ones where growth is still significantly higher. In fact, as per this is from the last IMF report, which came out about I think week or 2 weeks back. Uh, India's growth projection is nearly double that of the global projections, right, for 25, and next year and the year after that. So India is definitely in a sweet spot when we look at it from a very high level perspective. The other important thing is we are seeing a significant reduction in inflation across the world, right? So uh, again, you look at US, you look at Europe, you look at China, you look at Australia, or nearly every zone you are seeing that structurally inflation is coming down. And that is basically putting, and it's allowing the central banks to cut policy rates. Now, if you look at this chart, this is very interesting because the number of rate cuts that we are seeing has become very significant. And if you see, the only two times where we had higher rate cuts were when the world was uh, basically headed for a major macro event, or when we had seen a major macro event, not headed for. So 2008 global financial crisis, macros were in a mess. 2020 COVID, again macros were in a mess. So after a very long period, we are seeing a time when we are seeing cuts without a major macro event happening. If you maybe sort of not consider uh, the the wars that is happening as triggering events, which I personally don't think that the central banks are reacting to the wars, because primarily, if you see, the biggest impact that is seen usually in a war is a spike in crude prices, which has not happened this time, and we can maybe uh, talk about it a little bit later. I'm not a crude expert, but basically there are a lot of pushes and pulls in the crude market to mostly related to geopolitics, which is keeping a cap pretty much on crude prices. But the point I'm trying to make here is that after nearly 20 years, we are, or maybe longer, we are seeing rate cuts across the globe without a major macroeconomic uh, catastrophe. Now, typically, falling rates are good for equity markets. Now, let's come and look at what is happening in India, right? So, India, uh, if I look at it again from a 30,000 feet level, broad base, India is doing, really, really well when I compare it to the world. When I look at, a bit closer, slightly shorter term, what we are seeing is a slight slowdown within that phase of growth that we have. So I'm trying to build a picture in terms of where we are as a country. Uh, Last 2 months, August, July, August, part of September, I think we've had a fair amount of slowdown, mostly in all macroeconomic factors, especially the fast-moving macroeconomic indicators. And it could be attributed to many things. Economists are attributing it primarily to two factors. One is very heavy rainfall, which disrupted normal business and commerce, and secondly to the central elections, which again put a lid to central government uh, capex. The good part is again the October numbers which came out, I think, a couple of days back this week, uh, has shown a rebound. So again, going by what the commentary was from RBI deputy governor, I was reading through it, and they also feel that it is transitory, not that it means much. Most of the time, what I've seen is most central banks are uh, fairly behind the curve in terms of uh, realizing or understanding, uh, you know, slowdowns or growth pickups. But what we are seeing probably is a reflection of the fact that uh, the bigger part of the growth in India was coming from state and central government investments. Due to the elections and due to monsoons, there was some, cutback in that. Once and as and when it starts picking up, we are going to see uh, a more important, a more robust growth coming forward. Now, coming to the markets, I think everybody knows it by now. People who even once in a while look at the markets, is that last, I think, couple of months, markets have been not very kind. A lot of correction has happened. Most of it is not really that visible in the top line indices like Nifty or Sensex or even some broader indices. But what is happening is that if I look at the market as an aggregate, there has been a significant amount of correction. Again, a lot of attributions are happening. Why it is happening? There was a news report which said that margin trading facility has been taken out from over 1,000 stocks. So that is impacting the mid and small caps. There was also a report that because of the political situation between India and Canada, some Canadian funds are selling. Uh, there also reports of, again, SEBI and RBI trying to discourage FNO exuberance in the SME IPO space. So all of it overall is giving a scenario where it shows that things needs to calm down, because right now we are in a vortex of negative news flow when it comes to the markets in general, right? Uh, Now this is one of my favorite slides. I keep this slide. This is fairly dated, 7-8 years back. I saw this in, I think this was from Fortune magazine that I picked it up from. And I keep it more as a reminder that every year, if you go back, you will find something or the other which has concerned the world, which has concerned investor. Every year you'll find some negative news. And when that negative news happens, the news media and everybody around you, and more so today, uh, all negative news gets amplified manifold because of, WhatsApp and Twitter and Telegram and YouTube, because everybody is sort of just retweeting and re-forwarding and uh, uh, just spreading the news, especially if it is bad news or if it is news which is which sort of creates fear in the minds of people. Uh, so again, if I take a very long term, this is the entire duration of Sensex, right from its inception till today. I've taken a log chart. So uh, the difference between a normal chart and a log chart basically is that you see percentage moves uniform or sort of made uniform in a log chart. So if you see uh, this kind of a chart, it just tells you that over any reasonable period of time, you will see that a growing economy like India will do well, right? And in this period, and if I just go back, say from 1990, right, we've had nine prime ministers, nine prime ministerial terms with seven different prime ministers, different political parties. We've had COVID, we've had the Chinese market crash in 15-16. People who've completely forgotten that now. We've had the European debt crisis, we've had global financial crisis, we had the dot-com bust, we had the Asian financial crisis, we had Harshad Mehta. And despite all of that, the markets have continued to do well. And the reason why it continues to do well, and I keep repeating that, in a growing economy, in an economy which is growing, markets tend to do well because businesses do well. Businesses do well because your economy is growing, uh, your demographic is growing, you have more people, you have one of the biggest challenges today that faces the world is a declining population. And once you have a declining population, consumption etc slows down. And that is one of the biggest reasons why a lot of people, when they talk about long term market growth or market stasis, they give the example of Japan. Now I've studied Japan very, very extensively. And you know some of the reasons that people don't talk about is that Japan population growth started contracting pretty much the same time when the market started crashing, and in early 80s, mid 80s, that is when Japan sort of peaked off in their population growth. The same thing we are seeing now in China. So, no matter what people say, my gut feeling is that China is going to struggle to grow even half as well as it had grown in the last 20 years, simply because now their demography is a headwind instead of a tailwind that it saw earlier. Now, India is in a sweet spot because our demography, purely in terms of numbers, are a tailwind for us, at least for the next 15 to 20 years. After which, we are going to face the same headwind that China and Japan and all European countries are facing today. And if you look at state-wise demography, state-wise population growth, you will see that large parts of India are now below the 2.1 uh, uh, fertility rate, which means that our population is going to see a degrowth in most of our prosperous states. So that dynamic is going to change somewhere around the 2050 kind of mark. So that's something that we need to keep at the back of our mind for very, very long term investors. Now, when we look at all of this gloom and doom, I actually tried to make this chart uh, I think I was sitting and doing this on Friday. We tend, as Indians, we tend to be very, very skeptical about our country. We always are very quick in criticizing, in saying or deriding, what we've been as a country been able to achieve. So I wanted to just take a look at some of the big picture thing. Right now, we are the fifth largest economy. IMF, World Bank, all global agencies say that we should be in the fourth and the third largest economy pretty much within the next 3 years. Even if I give it some more time, maybe 4 years, 5 years, right? By 2030, we should be the third largest economy in the world. In terms of mobile data usage, we are, you know, by far the largest in terms of mobile data usage. We have the fourth largest iron ore reserve in the world. We're the third largest pharma industry in the world, second largest refiner in Asia for oil and gas. We're the third largest consumer market uh, uh, after US and China. The largest fintech adoption in India. If when I look at what UPI has done, it's just extraordinary, right? Uh, Vaccines, we're the world largest producer of vaccines, third largest producer of chemicals, fourth largest railway network, second largest startup ecosystem in the world, second largest, coal. We are one of the biggest mobile handset manufacturers in the world, largest milk producer, second largest producer of fruits and vegetables, and so on and so forth. And the, the point is that we are a country which has done well. If you look at the performance of India decade by decade, and think about people especially who are 40, 50, 60 years old, just go back in time and think about when you were in school, and you will realize how far as a country that we've progressed. The challenges that we see today, joblessness, uh, politicians not being of the greatest variety, uh, problems of poverty, none of that is new. If I'm a huge Amitabh Bachchan fan. In fact, last evening I was probably watching Diwar for I don't know, maybe the 12th time. The same challenges was there in the 70s. You look back in, again, look at the movies that we've done, popular movies. None of those challenges that we see today have changed dramatically. The core challenges remain the same. Uh, so what I'm trying to say is that we've made huge progress. There's still a long way to go, but we should not be despondent about the economy, about what we are doing in our place in the world. So this is again something which I found very, very interesting, which is that we're all waiting for private capex to pick up. It's not that private capex is picking up a lot, but definitely in the last 10 years, uh, this year has been the best in terms of project funding, private capex. So again, something that is slowly showing signs of improvement. If you look at power consumption data, if you look at power production, capex in power sector, so these are all lead indicators of an economy which is picking up. So this is what is encouraging to me. And like I said, uh, although we are moving, our median age is moving from 22, 23 to 28, 29 this year. I think we remain one of the youngest uh, population in the world, definitely one of the youngest population in a large economy in the world. So opportunity is there for us to sort of grab it, whether in terms of services or in terms of manufacturing. If I look at valuations, right? Everybody is talking about valuations. Uh, Nifty P last 10 years we are actually below the median today after the correction of the last 1 or 2 months. Same for Nifty. I mean, the previous chart was for Nifty 500. This is for Nifty 50. The last 10 years, we are now below median, right? So are we obnoxiously valued? Definitely not. At an aggregate market level, we are, I would say, at a reasonable valuation. Are there overvaluation in pockets? Definitely. There are sectors which have run up a lot. There are businesses which have run up a lot. There are stocks which are at 100, 150, 200, 250 times earnings. But that is par for the course. In any bull market, we see stocks which far deviate from their uh, normalized valuations, and therein lies the opportunity also, therein lies the risk also, right? Now, I said I'll talk about how we are thinking about the current situation and how do we normally think about investing. So some or maybe all of you have seen this slides before. This is how we look at when we invest or evaluate businesses for our long-term portfolio, which is Shree Lakshmi. Right? We have a 9-box framework where we look at, fundamentally we look at top line, bottom line growth. We look at businesses where there's a large opportunity size with good management. I'm very cautious about companies with very high leverage. I want to stay away from companies which borrow a lot. Looking for dominant market share or companies which are able to increase market share over time, which has a business advantage which is sustainable over a period of time. Shareholder friendly management, good corporate governance track records. And when it comes to valuations, I'm looking for reasonable valuations, because my experience is that unless you are at the bottom of a bear market, you will never find good companies or companies which exhibit all of these criteria or most of these criteria at very cheap valuations. It's not going to happen, right? So as long as you are able to buy them at reasonable valuations, results tend to be reasonably good. Right now, I think our focus is more on looking for companies where growth is visible, or there is visibility of growth for at least the next 2 to 3 years, and where there is market share dominance. That is where I think the bigger focus now is, because of the turbulence in the market today. Because once you have growth and increasing market share, the possibilities of that company holding on its valuation, even in tough times, or holding on to its price with less uh, drawdowns, increases. So that is what we are focusing on. This is for Shree Vriddhi. Shree Vriddhi, as you all know, is more opportunistic in nature, where we are looking for shorter business cycles which play out between 2 months, 3 months, 6 months, maybe a year kind of period. Again, we look for fundamentally sound companies, which is again increasing their market share, low or very reducing leverage. Now we are looking for focusing on industries or businesses which are seeing turnarounds, right? So short to medium term companies which are possibly, which has gone through bad times in the last few months or last few quarters or last few years, and maybe they are sort of seeing a upturn in their business cycle. That is what we are trying to look for now. So in essence, our focus now is to look for companies where there is growth, where there is visibility of earnings in the near future, and where there is possibly limited downside. Now, with all of this, I think another very important factor that we need to look at is how do we protect capital from permanent loss, right? So obviously, first thing is we are reasonably diversified. We have between 15 to 20 stocks in Sri Lakshmi at any point in time. We have about 10 stocks in Sri Vriddhi. We are diversified across multiple sectors. We look for only fundamentally sound companies. We don't buy companies where management is question mark, where businesses are question mark, right? And we keep changing our allocations based on uh, the tactical situation in the market. And most importantly, I think we are one of those very few funds that have a stop loss across its uh, holdings. So whether it is Sri Lakshmi for long term, whether it is Sri Vriddhi, we have stop losses in place. They are not very short, 2-3%, 5% kind of stop losses, because we are not interested in very short term trading. We are investors trying to play either short or long term business cycles. Uh, so our objective is mainly to try and look and limit our uh, losses. Just one second, let me put in the okay. Okay, sorry about that. My laptop actually, I forgot to turn it. One second. Let me resume. Okay, I'm assuming you're able to see the screen. Yeah. Okay. So, sorry about this, but basically, what where I left off was we have a stop loss in place. Our maximum drawdowns are limited, but also we don't want to continuously have very short stop losses and keep getting stopped out in a very choppy market. And right now, I think we are in a phase. I think last time in the monthly video that I shared with all of you, I spoke about that we are getting into a phase where probably we are going to get into a consolidation over a few months. I think right now we are part of that consolidation phase. Bull markets see such sharp drop downs, uh, corrections pretty much uh, once every year, or sometimes more than a year. I think I've covered everything. Yeah. So with that, let me pause here and open it up for questions. So you can either unmute yourself and ask the questions, or you can put them in the chat box and we can take them one by one. Okay, Animesh, you go first. You can, yeah.
Abhishek, the question is, how do you view financialization as a theme for the coming years? Because I've generally seen that in your portfolios, you've never had, any, let's say, exchanges, depositories, brokerages. Very rarely I've seen you take positions in that. Given that you're so bullish on the economy from a medium to long term perspective, how do you view financialization as a theme?
Okay, Animesh, thank you for your question. I think, see, there are two parts to answering this question. One part is uh, about financialization and that segment, whether it is exchanges. So let's talk about what are the industries that are there. So we have exchanges, we have depositories, we have insurance companies, we have AMCs, we have wealth management companies, uh, brokerages. So all of that is part of the financialization theme. I think all of them will do well. I think it is very, very important or to realize that India is, like I said, it's a growing economy. More and more people are going to get invested in the markets. So this entire uh, pack is going to do well. Now, coming to the fact that why don't we have one or more or whatever number of stocks in that? Now, portfolio construction is not buying something which which you like. Now, let me explain that. So, let's say in Shree Lakshmi, we have between 15 to 20 stocks. Now, we can discuss and debate about why 15 to 20, why not 30. My belief is beyond 20, you lose the benefit of diversification and your returns on stocks which do well dwindle down. So when we get multi-baggers, we've seen how stocks in our portfolio like Trent or Varun Beverages or HBL Power, similar such stocks. I mean, a lot of recall how they have performed over the last 2.5 years. Right? They've been multi-baggers. The benefit that we derive out of them reduces if you have 2-3% positions versus maybe 5-6-7-8% positions. So that is one. So to keep 15 or 20 stocks, ultimately what you need to do is you need to be selective in terms of what you are putting into the into your portfolio. So it is like selecting a cricket team. You only have 11 slots, maybe 6 batsmen, 1 wicket keeper, and 4 bowlers, or whatever combination. Maybe you've thought about that, right? Now you have 20 batsmen who are doing, performing phenomenally well, but you cannot take all 20, right? You have to decide that I want to take 5 or 6 of them. So that is the dilemma of a fund manager. When you look at, say, the top 500 companies, you look at the NSE 500 or the BSE 500, at any point in time, you will find 50 companies which are doing well. Now, your option, one option is to create a basket of 50 companies and wait. That will give you index kind of returns. And I am not interested in index kind of returns, right? Not that there's anything wrong per se in having index kind of returns, but I'm not personally, as an investor, I'm not interested in sort of having a very large basket and being passive about it. So within those companies which are doing well, the job is to, so when you're selecting, say, batsman, bowler, whatever, you're looking at two things. You are looking at the class and you are looking at form. So you are looking at both the long-term prospect and you are looking at very short-term, near-term performance. So you are trying to get people who are a combination of the two. You want great players who are in form. You don't want great players who are out of form. You don't want bad players who are in form because you never know when they'll go out of form, right? So that is what we are essentially trying to do. So I am not saying that I will never have uh, any one of these financialization theme stocks. At some point in time, if I find that it will come into the top 15 or top 20 in Lakshmi or in the top 10 in Vriddhi, definitely we'll have them.
Thanks, Abhishek.
Sure. Okay, there are a couple of questions, or maybe more than a couple in the chat box. So let me quickly go through them. So Sudarshan is asking, with IT rule change and higher gap between STCG and LTCG, are we looking at lesser churn now, especially in Vriddhi? Yeah, so first of all, Lakshmi, we have low churn. Vriddhi, we have high churn because the nature of the fund is to look for shorter business cycles. I don't personally, if you ask me, as an investor, I don't look at income tax. I don't look at brokerage fees. I don't look at STT because, in my opinion, over say a lifetime of investing, uh, it really does not matter. Uh, if you do Excel exercise, if you listen to influencers on whatever platform you are, you will they will explain it to you that fees, charges, taxes are very important and you will lose out on so much over a 20 or 30-year period. But my personal take is, if you can get slightly higher returns by doing something, uh, it really doesn't make sense, because end of the day you are paying taxes on the profits you are making. You're not paying taxes on losses, right? As long as the churn is reasonable and it is overall profitable, right, then it makes sense to have churn. If it is not profitable, uh, and in a market, in fact, in a market like the regime that we are seeing today, my personal take is that it is slightly better to have slightly longer stop losses, uh, so that you give stocks a little bit more wriggle room to, so that you don't get continuously chopped in and out of your investments. The next question is from Sudarshan again. What is your views on renewable solar theme, especially companies doing EPC in this space? I think I'm fairly positive on uh, all of these transition economy stocks. So when I talk about transition economy, what I mean is anything where we are moving from X to Y. So that is moving from fossil fuels to to solar, to wind, to nuclear in terms of power. Uh, when we are moving from ICE engines to EVs to hybrids, when we are moving from traditional telecommunication to 4G, 5G, Starlink, etc. So all of these, to me, are transitory phases. You could also uh, think of financialization as a transition. We are moving from traditional fixed income, fixed deposits, uh, you know, kind of investments to more market determined securities. So I think all of this is going to play out. These are all decadal themes. It is going to take a lot of long periods of time. There will be good times and bad times even within this. So you'll have shorter cycles play out. But over the next 10, 15, 20 years, I think all of these sectors will do well. Now, the caveat here is that a lot of these companies are valued at extremely high valuations. Now, you've probably heard me say a lot of times before that I'm not very, very hung up on valuations. Having said that, uh, I'm not I don't completely disregard valuations. You know, beyond a certain level, which is typically for me between 2 times to 3 times of your index valuation. So roughly, if Nifty today is at 23, 24, 25 times, I am okay to pay twice or thrice that if a company has very good prospects. So basically, I'm okay to pay maximum up to say 50 to 70, 75 times. But beyond that, you have to be really, really great in terms of what you are going to achieve in the next 2, 3, 4, 5, 10 years for me to be able to seriously consider you for investments. right? So that is what I think in terms of the sector and in terms of actually buying individual stocks in them. Next question.
Abhishek, sorry to come in. You mentioned about the max that table, for buying a company at. But I'm seeing, especially in case of Lakshmi, I think there are a few stocks which are currently being traded at a P which is like much higher than the number that you are indicating. So
Correct.
is there a reason? The reason that they're growing at a fast rate, and therefore
Right. Okay.
because of that.
Again,
So if you could just
this is Gagan, right?
yes.
Yeah. Okay. So, Gagan, again, great question. So if you see what has happened, I think that couple of stocks like that, Varun Beverages is one, Trent is another. When I bought both of these stocks at the inception of the fund, right? Uh, they were expensive, but they were not at the valuations that they were today. And my experience is that as long as a company grows, uh, especially at a rate which is 20 to 25% and above YOY every quarter, the valuations don't contract significantly. It is only when that growth stops does the music stop. Now there are again another thing that I've observed over the years is uh, a company which is growing at 40, 50, 60% for a few years, the market will give it a longer rope to show that it is degrowing. Now if you go back and see a company like, for example, say HDFC Bank or a Bajaj Finance or any such company which grew for very long periods of time at exorbitant rates, the market took a long time to devalue them or to sort of bring down their PE levels. So at some point in time, Varun Beverages and Trent will come back to two-digit P's. I'm sure of that. But I am not very quick in selling right now because I have observed through my bitter experience that selling on valuations is one of the most stupid things to do. You leave a lot on the table if you're selling based on valuations, right? So selling has to be based on growth parameters and technical parameters. These are the only two things in my experience which works more often than not. Again, both buying and selling are probabilistic by nature. You cannot be 100% sure or you cannot be 100% right in both buying and selling, right? In either of these cases, there are possibilities that you will go wrong. But having said that, as long as the growth persists, I am happy to be a fair weather friend of growing businesses. If it stops growing, they are not. I have not inherited those businesses from my parents, so I am happy to get rid of them. Okay.
So Abhishek, just a follow. So Abhishek, just a follow. So are we saying that, as long as growth is there for these, then you are happy to sort of buy them at whatever price they are?
As long as growth
If you see,
persists.
I think please.
Yeah, sorry, go ahead.
No, I'm saying if you see currently a trend, the value at which is being traded, I think more than 150. I know P on its own is not only one determinant, but I'm just wondering if it, so assume that now you have funds to sort of invest in company. Would you continue to buy Trend and the likes of similar companies, or you say now looking at the
So
risk reward? I think
that's exactly what I tried to explain, is that as long as a company keeps growing, what you will see is that the the stock price sort of tends to follow its earnings growth, and the P will probably not expand from here. I might be wrong; it can expand from here as well. And you go back to history and look at any company which has grown for a significant amount of time uh, over history, right? I mean, there've been multiple such examples. Uh, I have personally sold off companies at 100 P to have seen it go up to 200, and been multi-baggers I've missed out on 100 baggers because after a 10 bagger, I thought, this is at 100 rupee, let me get out. And later I've seen that it has gone up 10x from there as well. And even today, that stock is probably at 75, 80p, right? So there are hundreds of examples I can give you over the last 20, 25 years where I've seen such, things. May not be hundreds, but definitely, 25, 30 such examples. And what I've seen is, if a company is able to deliver, you should not try to, be over smart. A lot of times we leave money on the table because we have all these, textbook notions in our head that itna P hona chahiye, itna ye hona chahiye, right? Uh, my personal experience is practical life uh, tells me that as long as the business momentum continues, the stocks tend to do well. And if you just see an example of trend, right? When I bought it, I think it was 75, 80 P. Today it is at whatever, I don't even know what P it is today. Maybe 130, 140, 150, whatever. And it can it go from 150 to 200, 250? I don't know. Maybe it can. Can it go from 250 to from 150 to 75? Sure, it can, right? But typically, the price action that happens is once that consolidation phase happens when the growth starts stopping, or there is a pause in growth. The second thing that happens in these kinds of companies is they go into a consolidation. They don't usually fall off a cliff, right? So you will get enough time to evaluate, the growth and the business, and take a dispassionate view and get out in these kinds of stocks. That's been my experience. Maybe I'll be proven wrong and I'll learn from it. But my experience is that as long as growth continues, stocks tend to outperform.
Sure. Thank you. Appreciate it.
Okay. Moving on to the next question. This question is from Richa. Is it a good time to invest more money into the markets, or is it a time to sit out? This is a question that I get at least 2 to 3 times every day from friends, family, investors, everyone. And the simple answer to this question is, if you ask me at any point in time, I have the same answer. The answer is, it depends on your time horizon. If you are investing for 6 months, I don't have an answer for you, whether it's a good time or a bad time. If you are investing for 6 months, I think it's always a bad time. If you are investing for 3 years or more, I think any time is a good time. Because, I'll try and give you my rationale. Typically, what I've seen is, even if tomorrow a catastrophe happens and the market falls 20% even from here, in Indian markets, it will take roughly 2 to 3 years. And remember that market cycles have, sort of crunched over the last few, decades. What used to happen over 10 years now happens over 4, 5 years. So it will typically take 2 to 3 years for markets to sort of again consolidate and get back on its feet. So if you have a 3 to 5 year horizon, I think it is important to take a much bigger picture and to get more capital deployed, because investing is a game which is the only thing from a portfolio perspective is return on equity, right? The more equity you have, the higher returns in absolute terms you will get. If you have invested 1 crore and you get a 20% return, you will get 20 lakhs. If you invest 10 crores, you will get 2 crores, right? On the same 20% return. So the point here is that you should take opportunities like this, where markets are falling, to invest. Now, what do you do when markets are at an all-time high? Markets are keeping going up. That is the time, I think, when you should sort of stagger. In fact, if you are a normal investor, it is best to always, stagger, set up a, talk to our client support team, set up a monthly or a quarterly SIP, so that you are always investing in, smaller chunks, so that your capital base keeps growing up. And the other advantage that I've seen, again personally, is the if you do sort of SIPs, it doesn't hurt you as much as putting in a lump sum in bulk. You just stagger it over a period of time, you keep investing, and the objective has to be that you should think about enlarging your corpus, right? So the higher corpus you build over the next 5 years, 10 years, compounding will start to do its magic. So that's what I do personally, and that's what I suggest all my friends, family, everyone to do. The next question is from Ramachandra Bhatt. Question is little technical. Along with your expertise, uh, how are you and team leveraging technology or AI to identify stocks? If the answer is yes for AI, what is the success rate AI posted? Okay, thank you. Thanks for this question. I was not planning to talk about this, but let me talk about it. Last 6 months, I have been working extensively personally on machine learning. I have my oldest friend, oldest not in terms of age, but a friend who's been, sort of a friend for me since we were like 3 years old. He's a data scientist. He's a professor in the US. He's on a sabbatical. I've sort of coaxed him to come for a sabbatical, and we're working together using machine learning twofolds. One is to create systems which will help us in identifying stocks, in building algorithms for buying and selling. And the second is to aid our research process through creating systems for data collation, for aggregating news, for sentiment analysis, and all sorts of things, right? So it's a bit premature for me to talk about it. We've sort of working on it. None of it right now is something which we are confident of deploying for investors. We're trying it on a very, very small piecemeal basis. We're doing back testing. We are doing all of that. It will take some time to mature. But what the kind of work we are doing, at least I think very few people in India, I mean, forget India, I think very few people in the world are trying that, because we are also looking at research papers, published papers. I don't think anyone is sort of trying to do the kind of things that we are trying to do in terms of using machine learning the way we are doing. And let me clarify, we are not trying to use it for very short-term trading systems. We are trying to do it for longer-term investment kind of mechanisms. If we are successful, keeping my fingers crossed, you'll definitely see the benefit of it in your portfolios getting reflected. You'll and maybe at some point in time, I'll share much more on what we are doing and how things are shaping up. Next question is from Harsh. When we invest with Shree Rama managers, do you advise on how much of our portfolio should be in Vriddhi and how much should be in Lakshmi based on our goals? I don't personally do that. You can talk to Mohit or our team who do the onboarding, but what I personally suggest to everyone, all my friends and family who are part of the PMS, I tell them, when you are starting off, just go with a 50-50 split, right? Try to keep it simple, see how it goes, and then you can sort of augment or add onto the fund that you feel is more closer to the mindset that you have. But I think just spreading it out evenly, 50-50 between the two, is a reasonable approach. The next question is from Shubham. What is your advice to people who started off with Shree Vriddhi in October only or last couple of months, and what's going to be strategy going forward? I think people who've started off recently on the last few months, I think just remain invested, just continue, because this is a market phase. Uh, this will sort of pass. Maybe personally, I'm expecting a bounce back sometime this week, next week. Whether that bounce back sustains is something that we need to see. But this is a phase. Whenever you are investing in equity markets, like I always say, and that is one of the main reasons why we've got exit criteria or exit load for 3 years. Is not because we want to make money out of it, but simply because we want people who have more than 3 years of time horizon only to invest with us. So you basically do nothing. I mean, you don't have to always uh, uh, take a daily view of what is happening uh, with your fund or what is happening in the markets. One reason I think personally to invest in a PMS or in a mutual fund or any such structure is to take yourself away from the day-to-day rigmarole of the markets and focus on what else you are doing, right? That's my personal take. The next question is from Sudarshan. Any plan of starting Cat 3 AIF from Sri Rama? I don't think we've discussed it right now. I think we're focused now on the PMS, and that's what we're focusing on. We've still not turned 3, so I don't think we are right now trying to do too many things. We're trying to do one thing well, and let's see where that takes us. Okay. Next question is from Harsh. Do both funds only invest in equity, or do you also invest in debt funds, SGB, etc.? We don't invest in usually in debt funds, SGB, etc. We are typically an equity only fund. Primarily because I think for the time frame that we look at, 3 to 5 years or more, you can't really beat equities in terms of returns. And over, say, a 10-year period, I personally think the only way to really create wealth is through equities by investing in businesses which are run well, which are growing, which are capturing value in the overall economy. I think that is the only way to create wealth. But that's my view. I've not seen anybody really get wealthy by investing in fixed income or by investing in gold bonds, etc. People who are rich, you can put some of it to preserve your wealth. But if you want to really create wealth over a fairly long period of time, I think the only sensible option is investing in businesses. The next question is from Shubhendu. How do you see PSU stocks in different sectors in next 1 year? I mean, in view of this decent correction in these sectors. So first of all, I don't consider PSU stocks separately. I consider stocks in a sector or an industry. So PSU stocks means that they have a common, promoter, which is the government of India. But you have to look at stocks more. If you're doing a top-down analysis, you have to look at it more from their industries they are in. So whether it is railways, whether it is infrastructure, whether it is defense, whether it is banking, whatnot, right? So opportunities will depend on the sector that they are in, the valuations that the companies are in, the growth prospects that the companies have. It's a combination of all of these. I don't think just being a PSU gives you an advantage or disadvantage. In fact, for most of my investing life, I think PSUs were a disadvantage. I continue to believe so, that PSUs, because of government ownership, uh, is restricted in doing many things that a private enterprise can do. So uh, I would be very, very skeptical of long-term outperformance of PSUs with respect to their counterparts in private sector. Uh, what we saw is sort of mean reversion in PSUs, where they were always very poorly valued. Once the numbers started coming, they've sort of mean reverted, done extremely well, and they've sort of now corrected in the last few months. You have to take uh, every business case by case and look at what their prospects are. I don't think we should, broad base and say PSUs or Tata Group or Adani or Ambani or whatever, should be a blanket buy or sell. Okay, I think that is all the questions that we have in the chat box. We've already spent 1 hour 15 minutes. So maybe if anyone has any last, maybe 1 or 2 questions, we can take them, or we will maybe close.
Abhishek, the one more question I had, I was just waiting for everybody to finish. Have you seen anything in the geospatial sector? In specific companies like Genesis, Sane Systems, and there are some others which I can't recall right now. But where there is like projects for smart cities, or like they're saying they will be digitally marking land. Have you seen anything in this space, and do you like that sector?
So the short answer to your first question, I've seen all the names that you've talked about. The second answer to your question is I will not tell you whether I like them or not. Definitely not not in public.
No, not name specific, but in general, do you see the sector doing well? This kind of a sector, it's
I
slightly.
would think so. I would think so. But you have to be very specific in picking the right stocks.
Right, sure, thank you.
Shubhendu, you have a last question? Yeah, go ahead. Shubhendu, you have a question, or okay? So
Hello. Abhishek
yeah.
sir, I have a question. Uh, so sir, in last 1 month there has been a lot of FII selling, and there are many experts who are also suggesting that there's going to be a P re-rating for majority of Indian companies, and so there is a lot of panic around that also. So just wanted to understand that like how do we foresee next 1 year in this regard, that are these really true, or when we can see a turnaround in terms of FII buying and uh, all of these things.
Okay. So first answer is that if first of all, I think media wants and likes to uh, give big headlines, right? So first of all, let us understand who are FIIs. FII is not one guy sitting somewhere in New York or London or wherever, right? They are all hundreds and thousands of different funds investing for different time horizons, investing different investing money with different return expectations, investing money with different base currencies. So we cannot generalize and say that FIIs will do X and FIIs will do Y, right? What we see is an aggregate of the behavior. Can we say that when we see DIIs numbers, can we say that all DIIs are buying? They are not, right? There are people who are selling. if you look at the last, say, 2-3 months, I've put this data up on Twitter, the difference, excluding, I think, for the month of October, if you go back till September, pretty much month for month, you will not see too much of a variance between FII selling and DII buying. But then in the last 2-3 months, the markets have been correcting, right? So it's not, so somebody has to be selling, right? So the point I'm trying to make is, one, we should not put all FIIs in one basket and try to understand if all FIIs will run away or everybody will start investing. Everybody invests with their own thought process. Now, having said that, there is no one, and I repeat this very, very clearly, there is no one on earth who can tell you what is going to happen tomorrow. No expert, any expert who claims, to tell you what is going to happen tomorrow is basically bluffing you, right? If anybody knew that, they would be trillionaires by now. I have not seen any, trillionaire or billionaire coming out of India just doing investing in the last few years. I think most people who've really created wealth have taken 20, 30, 40 years to build that wealth. So the point I'm trying to make is nobody knows what tomorrow is going to bring. What FIIs will do, what DIIs will do, when will mutual funds stop buying, when will FIIs start putting in money? Nobody knows that for sure. Now let's look at what is happening. So one of the reasons why I talked about the context in the beginning about macros is the world is uncertain, right? Every European country, bigger economies, including US, has started reducing rates. So rate reduction is happening because of two reasons. One, inflation is coming down, and two, growth is tapering off. Right? So in that kind of a scenario, short term, I don't know what will happen, but long term, people who are going to look for yield, who are looking for higher returns, will have to come to emerging markets. Right? We may see some tactical moves of money moving from India to China, from China to Vietnam, etc., etc. But again, if you look at it globally, the opportunity for deploying large amount of capital is limited, right? So I think India is one of those places where we will see significant investment over the next 5 to 10 years. Whether the next 6 months it will happen, I don't know. And no one knows for sure. But next, 3, 5, 10, 20 years, I think India will see huge amount of investment, both FDI as well as FII. And we are going to see continued and increasing DII investments, because people are, like, I think Animesh or somebody asked in the beginning about financialization of savings. We are seeing more and more youngsters who are joining the workforce, not going the FD route, not opening PPF, but opening a mutual fund SIP to start with, or opening up a demat account when in the beginning. So that journey is just beginning. That journey is going to take another 20 years at least. So interim, money flow will come in, go. Nobody knows for sure what will happen. But again, like I said, over a period of time, I think India is one of those places where if you are not investing as a investor, as a global investor, you will lose out. Just as a additional point, I've been reading Financial Times and Wall Street Journal pretty much for, I think, the last 5 years at least, maybe slightly longer. And if I think about the initial period, there used to be no good articles about India. There used to be no articles about India. Whatever 1-2 articles maybe in a week that used to come out in FT especially, used to be all negative about India, right? Mostly negative. If you look at FT today or the Wall Street Journal, and the specifically I'm naming these two because these are read by nearly all fund managers or all global business people. you will see that every day, pretty much you will have some story or the about India, and overwhelmingly, I mean, maybe 80% or more are positive, right? So that is the change in perception. If you read every day, will you see that change? No. That is why I say that whenever you are investing in equity, sometimes it helps to take a bird's eye view and just see what is happening. You know, like today, it is easier to visualize. Like you think of yourself as a drone, looking, you know, going up in there and looking at the landscape of what is happening, and in enhance your time horizon, and you will see that these things are playing out. It might not happen over a very short period, but it is happening. You look at the number of airports that are going up. If you look at the number of hotels that are coming up, you know, the rooms, look at the number of people who are traveling, right? I did not even talk about these things when we talked about the economy. The number of, you know, the hotel sector is one of the largest sectors which employ people from lower income households. So if you see a uh, travel and hotels, that money or that part gets, you know, sort of distributed to the to a large number of people. Same thing is happening in real estate. So these things will take time to percolate down to the ground level. And once you see this happening, again you will see a revival in consumption. You will see a revival in uh, capex. All of that will, you know, play out. That is why we have to have. So the reason why we have two funds like Lakshmi and Vriddhi is you will have long cycles and short cycles, and you have to be nimble enough to play both. And why you know, historically, if you see, Sri Vriddhi has given better returns than Sri Lakshmi. So then why do I even bother with Sri Lakshmi and not shut it down and have only Vriddhi? The reason is that my belief is over a 10-year period, uh, say if I, you know, we started this in 2022, if I go to 2032, my guess is that we will have similar performance in both these two funds, because long cycles and short cycles will sort of coincide at some point in time, although their timings will be different. I don't know whether I made sense when I'm trying to explain this, but the point I'm trying to make is, over the long term, you will see that long cycles in India is going to play out. Very short cycles, very difficult to predict. Nobody can predict what is going to happen tomorrow, day after, a week, a month down the line, right? A lot of random noise can happen tomorrow. If you see, Iran and Israel into a war, we might have might have a major correction. Uh, if something, drastically happens, if there's a nuclear war, if there is massive natural calamity, we don't know what will happen, right? Something happen, election results in the US, uh, depending on who wins, you could see a major kick in terms of market returns. That's what we saw in the last two elections, I think. Last two US elections. So I don't want to sort of get into that what is going to happen in the very short term phase. It's because not because it's simply because I don't want to, and because I'm not able to, right? But structurally, I think we are very well positioned uh, as an economy, as businesses. We are seeing new growth areas. I think again. Animesh asked about geospatial space. That's a wonderful new area that is picking up. Space research, again a new area that is picking up. Uh, Mobile manufacturing, electronics manufacturing. In fact, the entire manufacturing space in India, I'm very, very bullish about, because that is one space that India, the government, agencies are creating policies for. There is a huge amount of thrust that is coming. And again, if you see long term migration away from China is happening, right? Short term, we may not be seeing the benefits, but movement away from China is happening for sure. It took 25 years for China to get all those businesses. It is going to take an equal amount of time for people to move away from China, right? Board after board in US, in Europe are being asked about what is your India strategy in terms of businesses. I'm not talking about investing at all now. In businesses, in companies, the boards are asking the management, what is your India strategy? Do you have an India strategy? This was something which was unthinkable 10 years back, right? So, global, these GCCs are going to expand beyond IT, beyond pharma, right? So all of this is going to play out over the next decade, in my opinion. Personally, uh, I may sound bullish, and like Rakesh Jhunjhunwala used to say, I reserve the right to be wrong. I think the next 10 years is going to be the biggest, or I don't know whether it will be the biggest, but definitely it will be better than what we've seen in the last 10 years. I'm personally very bullish. So let's see how it plays out. Okay, I've spoken a lot. I've spent 1.5 hours. Maybe the last question is from Shubhendu. If I invest in Sri Vritti in 3 years view, should I do SIP or lump sum? It's your call. Personally, I would not like to hazard a opinion on that. It depends on how you want to invest. What are your personal goals? Uh, it's completely your call. Okay, think that was the last question. I don't see any other questions. And also, we've spent 1.5 hours. Thank you all for joining and taking time. And hoping that we will do this more frequently, hopefully every quarter, and if not, definitely once every 6 months. Thank you all for joining. Let me close this.